Hey, greetings traders and investors, and welcome back as always. Ben at Tyndall, tradinganalysis.com. It's Monday, March 7th, 2022, and I wanted to take just a moment of your day to invite you to an upcoming webinar event we have taking place this coming Saturday, March 12th. This will be held at 9 a.m. Pacific, noon Eastern, and in this webinar, we're going to tackle the market volatility that we've seen so far this year. Now, there's been a lot of uncertainties from inflation to the Fed to, of course, the geopolitical uncertainties with the Russia and Ukraine situation. And many of you are left wondering if this is the start of a larger bear market trend. That's exactly the question we're going to look to answer this Saturday, March 12th, 9 a.m. Pacific, noon Eastern. Hope to see you there. Tradinganalysis.com/webinar to get signed up today. Take care. Hey, good morning traders and investors, and welcome back to the Trading Analysis Wednesday live stream show. I'm your host, Ben at Tyndall. Hope you guys are doing well today. Welcome back. I can't believe we are approaching the end of the first quarter 2022. Still don't have those flying cars we're looking for, but anyways, hey, hope you're doing well. Wednesday the 9th coming up on another big event for markets. Tomorrow we have February's Consumer Price Index report due out. It's a good way to tee up next week's Fed meeting. A lot of back and forth in the markets, especially yesterday. Yesterday we had seen both the S&P, the Nasdaq, and the Dow Jones actually push south of their previous lows, and we've yet to break south of the February 24th area support. Yesterday, coincidentally enough, as we were kind of teetering on the 78.6% retracement of last resort, as we call it, we had news out regarding the Ukrainian president no longer pushing for NATO membership. And as a result, we saw a very significant intraday rally, likely an algo-driven short covering rally at this point. We still have the possibility of going lower. Before we get started, let's go ahead and bring in the trading analysis team. Good morning, Terry, and good morning, Alex. How are you guys doing today?
Oh, guys.
What's up, boys? Good morning, good morning. So,
well, interesting time.
Oh, very interesting times. It's just going to continue to get even more interesting as we approach next week's Fed meeting. The idea of a half a point move from the Fed has been pretty much faded. Investors are now pricing in about a 4% chance the Fed does nothing. What do you guys think about that possibility?
Well, Jerome Powell came out and said we're going to do a quarter point, and so I think that's what kind of calmed and reversed the markets last week. Anyway, was just getting that confirmation. The market doesn't like uncertainty, and when they I guess they hear it, and then the next thing will be is when they actually follow through next week, right? So
yep.
Is it tomorrow or next week?
Next week. Tomorrow we've got February's CPI data out. What do you think, Alex?
Tomorrow we also have ECB. That will be a very important one. I think Fed, of course, in these circumstances, quarter of points up because he announced it on the congressional hearing. But I think he will take a lot less hawkish stance, at least until this situation is on. And ECB is a completely different story. So Europe doesn't have any space to lift rates. Now you're going to see also interest rate differential because you're going to see dollar also trying to go a little bit higher, and ECB, if they stay accommodative, which they need to because the European economy will be exposed for the next couple of years, there is a lot of things to talk about there. So yeah, I think ECB will stay neutral to down, and Fed quarter of points, and let's see as we go ahead.
Yep, very good. Unless we get a 10% print tomorrow with February CPI data, I think they'll probably be safe at the quarter point. But I can tell you what, a half a point move would certainly be another event to spook investors and kind of shake out sentiment.
Yeah, I think definitely everybody will listen and look for signs what the Fed thinks for the next meeting. So now in this geopolitical unrest, basically information changing every day and situation changing every day. So I don't think people will think a lot about what will happen in the 6 months to year, because geopolitics changes very quickly. So they will look for what the Fed will do in the next meeting. So.
Very good, very good. Appreciate it, Alex. Glad to have you with us today. I'm going to take you guys through the charts. Terry will take you into Optima. Take a look at some sector rotation. Terry, any specific charts that you would like me to address while I'm working Motive Wave here?
Just continue on with that gold play right now, because gold broke back above the 2,000 mark this week, and so it's sitting at all-time highs right now, staged for another advance. But it's also been a pretty good run-up. So I'm curious as to what the fib levels tell us and where we expect the next little retracement, because I think that's going to be an ideal place for some re-entries on some of these gold miner plays.
Very good. Appreciate it. We'll have Alex in as well. He can take you through the macro scene. Boys, I'll be back on the other side, and we'll carry on from there. Sound good?
Yeah, see you there.
All right. Catch you in just a few minutes. All right, good morning once again, hitting the hard right edge of the Motive Wave platform. We're going to go full screen on the charts, taking a look at price action first in the S&P 500. So as we reviewed last week, there are a couple of distinct possibilities from an Elliott Wave perspective in terms of where markets go from here. And we've continued to view the more recent pullback from the January highs as our orange primary degree wave forward. Now, I will acknowledge going into, I think it was June of last year, we had anticipated a zone in the Nasdaq 100 between 15,300 and 16,000 that we did expect could shut the Nasdaq down for a larger correction. The issue that's occurred since meeting those upside targets, because as you know, the Nasdaq 100 high was right around the 16,000 handle. After meeting that upside zone, we, number one, didn't have the structure to substantiate such a sizable market correction as we had advised was possible this year. And then number two, in addition to not having the structure, if you look at the index heavyweights, there were many names that just showed this as a standard garden variety corrective retracement. So while we have charts such as communications and discretionary that are certainly challenging this wave four narrative, for now, we're going to take it one wave at a time and not get ahead of this market. We've yet to see a true shift in underlying sentiment, and for the time being, this does remain corrective. So looking at the daily chart in the S&P 500, bottom left-hand corner of your screen where you can see my crosshair is the March 2020 COVID low, where we complete our cycle degree fourth wave position. From there, we best track price action into the January 4th high as a three-wave progression, meaning 5 waves up into September of 20, 3 waves back into October of 20, and then 5 waves up into January 4th of 2022. This tells me that it would be difficult to suggest a cycle degree wave 5 completion. And I know there are some Elliottians out there in the industry that are looking for a more significant market correction. I don't see it as of yet. In the event we see that underlying shift, then we can act accordingly, and we have the clear key decision points to either validate or invalidate our preferred views. So getting you off of the daily, taking you down to the 1 hour time frame, and you can see the yellow circle for context. We're going to take you right into orange primary degree wave 4. We looked at 2 different decompositions of this fourth wave last week. The first suggests that in fact orange wave 4 finished as an overall complex. What that means is it's a combination of Elliott wave corrections. There's 3 corrections. In this instance, we see a combination of 3 wave moves. 3 waves to the downside into the 24th of January, 3 waves back into the early February highs, and then we get another 3-wave progression that takes us down into the 24th of February. So both the January and the February lows occurred on the 24th. From the low of the 24th, we do see evidence of what can be counted in 5 waves. Taking you a step further off of the 1 hour, just so we get a little bit better of a view of this structure, I'm going to drop another circle on, take you to the 15-minute chart. Looking at last week's price action, we had noted the idea that the initial three-wave decline into March 1st, which was Tuesday, so last Tuesday before we met on Wednesday, we had looked at this as an initial three-wave decline. We weren't ready to suggest that it was all of wave 2. Wednesday the 2nd, markets opened with a slight gap to the upside, and we saw continuation up into about 44.19, 44.15 in the S&P 500. If you were a member of ours, we had discussed very early on Wednesday the 2nd the idea that this looked to be corrective, because based on the time elapsed in our wave 1 breakout, excuse me, it was difficult to suggest that this three-wave move into Tuesday's low, March the 1st, was all of our green minor degree wave 2 correction. It was just a bit too short to say that that was all of the move. So we put out a wave count to our clients suggesting that we would meet resistance in the B wave at the 1272 external retracement of the A wave decline. The high was about 44.16, so we were 3 points off of the 1272. And then we've been essentially in distribution since Wednesday or Thursday the 3rd, and the structure that we've seen into yesterday's low before we got the news regarding the Ukrainian president and the NATO and the intraday rally, we completed what can be counted as 5 waves with an extended 5th wave position. This is a little bit unusual in that generally wave 3 is extended and you have the more clearly discernible 5-wave subdivision there. This doesn't break the count. So looking at the wave 2 support zone, we essentially met the retracement of last resort. The 786 retracement of the 5-wave mode of breakout was where we expected markets to put up a fight in the event this was the count that was at play. Wave count invalidation on this view would be a move south of the February 24th low. So interestingly enough, and coincidentally enough, when we met yesterday's 786 retracement in the indexes, the Nasdaq and the S&P 500, we got the news and markets rallied. Okay, after the rally yesterday, we faded into the close, and while we didn't break south of yesterday's low in the index, we got very close. So for the time being, this view remains valid. And if you look at yesterday's, and Terry's going to talk about this, this is his observation. If you look at the body, if you look at the candlestick for the Nasdaq and the S&P, you'll notice some indecision. So we need to either confirm or dismiss this view and either maintain 4157 and see continuation to the upside, or in the event we break lower, where does that leave us? Well, as we looked at last week, in the event we were to see markets break lower, we would not immediately assume the more bearish count, which is our wave 5, cycle degree wave 5 ending diagonal, which you can see over here. We introduced it a few weeks back. We would not immediately adopt this more bearish view that says, hey, look, the S&P could be on its way to 3,200 or maybe 3,000. We would instead acknowledge the fact that, number one, the correction's been a bit complex from the November area highs and, of course, into the January 2022 highs. In this view of orange primary degree wave 4, this view would suggest that wave 4 has yet to complete, and we actually have a move further south to go down towards 4,000 to 4020 in the S&P. The differences here are, instead of looking at the 3-wave decline into the 24th of January as a 3-wave W wave as part of a complex, this would be a standard 5-3-5 zigzag. Yeah, we would have to allow for truncation in wave 5. Yeah, we'd have a little bit of an unusual 3-wave retracement in B, but there's nothing wrong with this view. This count would suggest that yesterday's bounce was part of a B wave inside of an ongoing wave 5. So, just to reiterate, ABCW, ABCX, ABCY is the view that we have over here, which would suggest wave 4 is over. This has wave count invalidation at 4114. The alternate view is that this is simply a 5-3-5 zigzag, and this is only confirmed if we break south of 4114.65, and that would open us up for a move down to 4,000. Interestingly enough, there's a micro gap down at 40.20 in the S&P from April of last year, and that would essentially meet our downside zone of fib support. Downside zones of fib support include a quality of our initial actionary wave decline projected from our reactionary retracement. That gives us 40.26 up to 40.53. Now, if you're interested in staying up to date with the developments inside of these counts and inside of the subdivisions, we would encourage you to test drive our services. Join us for a trial. We put out updates and track these every day with our clients. Over to the Nasdaq 100. Here in the Nasdaq 100, admittedly, this chart has been a little bit more difficult to suggest as a wave 4, simply given the duration and magnitude of the wave 2 that we happen to be pairing it up against. That said, the view is not invalid, and looking at the orange 3 into orange wave 4 off of the daily down to the 1 hour time frame, we have the exact same view here. In fact, we pushed south of the 786 retracement in the Nasdaq yesterday, and we nearly met its February 24th area low, which would essentially confirm the move down to 12.5. So for now, while we technically can't dismiss the wave count that says orange wave 4 is over in the Nasdaq, and this is just a 3-wave flat, we did get very close. We spent a little bit more time under the 786 than I would have liked. Generally, we'd like to just kind of see a brief intraday stop run through that, but we spent a good period of time trading under the 786. So I wouldn't be surprised to see markets break south of 13,065 in the Nasdaq, confirm the continuation move, and then meet support at 12.5. So that's the Nasdaq and the S&P. I was going to cover gold and oil. I'm going to leave that for Alex. He is our macro guy. I will bring up the chart here of the Dow Jones Industrial. Taking a step back and looking at this in the most basic of Elliott concepts, this is not a directional trend off of the high for the Dow Jones. And granted, this is only encompassing 30 stocks, but it is a good representation of the idea and my belief that we are in a wave 4 position. We get a move in wave 5, and then we're up against potentially the larger market correction in 2022. A lot of variables. We've got the Fed, we've got inflation, we've got the geopolitical uncertainties with Russia and Ukraine. But for now, we remain optimistic, and we continue to track this one wave at a time. So here in the Dow Jones, 38% retracement fib of the wave 3 breakout has continued to act as support. You'll notice this is so far just a 3-wave structure. And getting you off of the daily, looking at price action off of its recent low, you've got the same structure. 5 waves up from the 24th of February, a big 3-wave pullback to the 786, 3 down, 3 up, 5 down to make a flat. Right now it remains valid. Wave count and validation, as you can see down there, 32,272.64. Now, I want to take a step back and acknowledge something, because as I went into last year, middle of last year, we had pointed out that very significant zone of resistance here in the Nasdaq. And I just want to kind of reiterate the fact that in the event things were to escalate beyond where they currently are, there is the potential for a larger wave 4. We've got a major 261.8% supercycle 3v1 fib target in the Nasdaq. And then if we look inside of supercycle wave 3, we've got cycle wave 5. So that's where I was able to identify the 15.3 to 16,000 zone going back to last year. And it has given us a pretty decent pullback. But I'll remind you of this. Looking at the chart of Apple, Apple being the more significant component, obviously, in the XLK being predominant weighting in S&P, and Apple being of significant weighting in the Nasdaq 100. After establishing a high in January, early January, Apple traced out 3 waves in a measured move fashion. 152.84 would have been the measured move. 152 was the low. We've rallied in 5 waves off of this. This looks very corrective. So as great as it would be to have forecasted that 15.3 to 16K top and have had the evidence to get behind it with conviction, we don't have that. We have evidence to support this as simply being a wave 4 pullback. We get one more push higher, and then we're in potentially for a larger pullback. Just as we looked at in the indexes, however, with the diagonal We could entertain the idea that we actually traced out a flat in the wave 4. But even so, if this were to be the case, we would anticipate a directional motive decline, as in a shift in underlying sentiment. We don't have that. We don't have that yet. It could develop, but we're going to take it one wave at a time and remain optimistic in the meantime. So that's it from me. I'm going to go ahead and jump back into... I'm going to go ahead and jump back to the team, and we'll get out of Motive Wave and transition into Optima. What do you guys think? 3-4, or are we looking at the larger diagonal count?
I'm interested on your red count, Bennett, where the invalidation point is if we get a break back above that wave 4 today, because we're looking at futures strong move higher overnight. And 42.37 right now, I think, if I'm looking at it, up 1.66%. So I'm curious if this morning rally fades before then, or what that actual level is on your chart that we should be looking for that really needs to break to get that confirmation move back to the upside.
Yeah,
and then
so
the same thing on the blue count to the downside is an invalidation there.
Yeah, let me see if I have our full team. I don't have that. There we go. All right, so we're going to be all on the screen here. Looking at this view, we could essentially, we could put a level at the 786 here in the red count that says, okay, if we get above the 4360 here, then chances are the B wave is not at work, and we're not going to move lower in C down to that 4,000 to 4020 target. We really can't dismiss the idea that the diagonal is valid until we move above 4489, but the signs will start to set in, above the 786. Right. And then obviously we would be looking for the structure of that breakout. And then the count here that says, the low is in, we need to maintain above 41, 1465.
Can't go beyond the origin of wave 1, so there's your invalidation point. That's just what I wanted to point out for everybody.
Yeah, absolutely. Appreciate it. All right, sir, you ready to jump in, bring them up to speed on sector focus? Yeah. All right, we'll be back on the other side. Take it away.
Hello, traders. I'm Terry Long at TradingAnalysis.com here with your weekly sector focus. Now, global tensions remain high due to the Russia-Ukraine situation, but we did hear from the Fed last Wednesday with a somewhat reassuring news to the markets of their plans to go ahead with a 25 basis point rate hike this month. However, there still remains enough uncertainty that will likely continue to drive market volatility in the near term. Now, looking at last week's price action here in the indexes, it was a very choppy trading week, with the S&P closing ultimately down 1.27%, and the NDX down 2.48%, about double. Really, the NDX took it a lot harder to the downside, but you can see both of them traded mostly sideways, and I think that's kind of apparent when you take a look over here at the sector performance. As crude oil prices remain at a decade high last week, the energy sector surged more than 9% higher, and the utility sector actually rallied 5%. On the downside, the financial sector took the big hit, down nearly 5% also. Now, growth sectors, technology, communications, and consumer discretionary, they were down about 2.5% to 3% each. And here in the middle, staple sectors seem to remain the resilient sector, essentially unchanged on the week. Let's fast forward to take a look at what's happening this week. Now, when the markets opened Monday for trading, the only direction seemed to be down. And the S&P closed down hard, 2.95% on Monday. The NDX closed down 3.75%. And Tuesday's action marked a bit of a reprieve intraday, as Bennett just shared with you, yet this faded somewhat in the afternoon trading. And down here in the NDX, it resulted in a spinning top formation. The spinning top formation, neither the bulls nor the bears actually could wrest control. And Bennett pointed something out to me earlier. If you look at the wick of the candle to the upside, which would be the bullish tug of war, it's longer than the push to the south there. But at the end of the day, we closed lower here, so you close closer to the bearish end of the stick. Now, despite this broad-based, I'm sorry, let me get back to my notes here. So the index only closed a fraction lower here on Tuesday, and despite this broad-based decline here, you can see this is Monday and Tuesday's price action. I've got over here 10 of the 11 sectors reporting a decline. But there were some very noticeable recovery bounces seen in certain semis, transports, and consumer discretionary stocks yesterday that did catch my attention. Now, moving over here to our sector scoreboard, it was another huge up week, obviously, for the energy sector. The energy sector continues to accelerate out here to the right to a whopping 118.6 relative strength ratio. Now, while a much more neutral flat week last week for the consumer staples sector, it's marked by a near zero momentum change with a little continued relative strength change. Now, this week, Monday and Tuesday's price action in staples is down 3.14%. The staples sector, which has been very resilient up until just this week, and I'll show you a chart here in a moment of that XLP. But now we're starting to see momentum fade out of the staples sector here. Now, also, the sharp 4.78% drop last week in the financial sector also has resulted in the upward momentum flattening for the financials. It's also caused the weekly chart to weaken, thus this vector has turned yellow. Now, meanwhile, we have the material sector and the healthcare sector remaining here in the leading quadrant and are now joined by the industrial sector as well. And for the past several weeks, we've seen the real estate sector move lower down here into this weakening quadrant. But we did show a bit of hook return last week. You can see this initial hook there and then another hook back to the south. So there's a little bit of indecision happening here in the real estate sector. Excuse me, one moment. Now, our growth sectors remain down here in the lagging quadrant as we see the XLK and the XLY with continued momentum and relative strength declines, though I would say the momentum fade in the consumer discretionary seems to be flattening out. And although communication sector is technically inside the improving quadrant, it looks to have lost its way over the last couple of weeks as it's just kind of sitting here with a total indecision. Now, several weeks before that, we've been seeing rising momentum, and that momentum has stalled out, and it's really just kind of hanging on for dear life, I guess you would say. Now, one of the things I want to share with you is I was talking about that daily candle on the NDX, and if you look up Investopedia, this is a great site to go to get information on the market. A spinning top candle is a candlestick pattern that has a short real body. It's vertically centered between the long upper and lower shadows, or wicks as we call them, and the real body is small. It shows little difference between the opening and closing prices. Now, buyers and sellers both pushed the price but couldn't maintain it. The pattern shows indecision and that more sideways momentum or movement could follow. Now, what does it tell you? The information here says that spinning tops are a sign of indecision in the asset. There was no meaningful change. The bulls sent the price higher, the bears sent it lower. The key takeaway I want to look at here is this indecision can signal either more sideways movement, especially if the spinning top occurred within an established range. It can also signal a possible price reversal if it occurs following a price advance or decline. Now, so since we've been in a decline, I'm getting kind of keen on seeing a bit of reversal, as I'm sure everyone else is too. So guys, go check out Investopedia there's lots of good information you can find here. You can read about all different types of candlesticks. And I'm no candle wizard myself, but I've looked at it a little bit. So that's all I've got for now, Bennett. I'll send it back to you.
Much appreciated. Thank you so much, Terry, as always. Yeah, looking at the spinning top candle at the bottom of a downtrend, it could most certainly potentially be signaling that reversal. So let's keep our eyes on the key levels and see what the cash session open brings. We've got about 10 minutes until the cash session opens. Alex, sir, how you doing today? We're going to pass presenter mode your direction. I've got that right now. Coming your way. Big move up in the dollar, pushing through that 618 retracement of the COVID decline. Pretty wild, pretty wild.
Yeah, yeah. I mean, dollar is. I mean, there is a couple of things here because this imbalance is. If you remember last or 2 years before, when the COVID started, when dollar was starting to move up, Fed actually offered the swap lines to central banks and actually tamed this dollar rally. Of course, nobody wants a stronger currency in a current situation, especially US. They will tolerate possibly a little bit of dollar strength, but I think they already have a prepared plan to flush the central banks with the swap lines. Because, as you know, dollar is still a reserve currency. Lots of foreign debt is denominated in dollars, so dollar going higher will wreck lots of even U.S. allies companies. So I don't think the Fed wants that. So I think it's tricky. I'm going to show the charts, but be wary of that if you are long dollars. That overnight. Put your stop someplace because overnight you can hear actually Fed is offering swap lines and actually stop the dollar rise.
Very good. Alex is going to take you through the macro scene, and we'll be back on the other side to wrap up. You ready, sir?
Yeah, sure. Let's go.
All right. Take it away.
Hey guys, so let's go, and I have a couple of charts to show you beside our usual chart. So 10-year yields, as you know, we are still tracking this chart. We do see some type of potentially leading diagonal forming on a smaller time frame. So you can count this as a 5 waves down. And I'm still going to keep this wave count. I think the Fed is not going to be too hawkish. And I think I explained that also the last time. So pretty much a relatively nice response. You can count 5 waves down for now. So in that, I'm going to stay on the short side in a sense of rates, especially for the next week. So this chart is pretty much valid with ABC on the upside relatively done. According to our levels, we tracked already for more than a year and even more. So I'm going to be looking over continuation of this in a 5 waves down, pullback in a B wave and down in a C wave, down to 1.14, 1.20% for now. This will be some of the support levels, and situation may calm if we go to the end of 2022. Or in a couple of months, and then actually Fed starts to hike a little bit more aggressive if the inflation stays. And I mean, with these prices of gas and oil, you can pretty much count that the inflation will go even higher, at least temporary, because the situation will not be solved very easily. I think that the current minus is around 2 to 3 million barrels a day. And this will be a supply glut for a longer time, and I think Terry knows that in much more in nitty-gritty than I am knowing that market. But looking at the rates and this type of inflation, we will be in some type of a very difficult situation, because you will see inflation going higher and central banks are unable actually to follow it. So that that will be actually environment which some other asset classes can thrive. And I have some theories about it, but more on that on tomorrow's crypto stream. The picture on the rate is going to stay same. I'm not going to change this outlook because we are seeing this small move on the upside. We are still trading well below this 2.04%. So I'm gonna continue to looking lower. In Germany, rates are moving a little bit lower towards the ECB tomorrow. Especially in these times, I think this chart has a significant meaning, because actually what this shows is that either in a triangle or in a more directional even manner, the price of a 10-year bond will go higher, so rates lower. So ECB, I don't think gonna follow the rate hike path. Even if they do a quarter of point, which I don't think they will do tomorrow, I think that over the next year, even two, European economy will be flooded with many problems, higher prices of gas, higher prices of oil, also geopolitical instability, also lots of people coming from Ukraine. This unfortunate event will also make some countries make some adjustments. So companies will have to adjust to higher prices. So European economy will not gonna look good in the next couple of years until actually you swallow and kind of adjust to these new circumstances. So I don't see there is any reason for ECB to be very hawkish on rates. So these charts actually give meaning to that, depicting a possible sideways or a more directional up in the yields in Europe going lower, and deflationary environment, or not now deflationary environment, but I mentioned even before this event that this move will either be caused by balancing of the economy and supply chains, or and the higher demographics kicks in, or some geopolitical events. And I mentioned that specifically on this show a couple of weeks ago, and now we have this geopolitical event, and we might see even inflation higher, but we are going to move higher in bond prices. So dollar, I have a two wave counts. We are still holding these levels. I have modified this from the ending diagonal, which still can be in place, but I like this one more. Also, you can fit a triangle here, and 1, 2, 3, 4, 5. We are moving lower now, 98.16. We are trading from this 1618. I'm still not sure in this situation. Definitely, I know that Fed doesn't want dollar to go pretty much on the upside. So as long as this levels holds, I'm going to hold this ABC and maybe a sideways consolidation more before we go higher. But alternatively, if we go into risk event more higher on the dollar, this will be some type of a triangle moving down in E wave and a little bit more upside up to 102, 106, and then I think Fed will actually intervene and bring US lower. So I'm still going to stay with the first wave count, with the possible sideways and a little bit more upside, because Fed is not going to be hawkish. And then depends on the geopolitical events. If this goes a couple of months in taking or in finishing in September, October, we might experience something like triangle and a small poke, and then a strong reversal to the downside. So one of the interesting charts which I have shown last time was I have showed you the oil. This is a very long-term oil chart. This chart goes back to 1862. So if you put this in a perspective, and as you remember, I counted this as a potential flat to 137. We have hit it to 130. But if we consider this geopolitical event, we have to modify possibly even a possibility that oil goes up to this 236 for this final fifth wave for the almost 200 even more years. It's not 200, it's something around that. But if you count this in 5 waves, you will see this is a wave 1 and 2, very nice development in a wave 3 to 2008 highs. We have a potentially triangle in B down in C, and now we are looking directional move. And one of the targets definitely which we use, measuring that from wave 4 to 5, as you can see, definitely comes around 0.32 for the measurement of the fifth wave. And that comes around 236, $240 per barrel, which in current situation, I will definitely not exclude. So these markets will be very volatile, so be careful if you trade them. If you look some other commodities, I will switch also to wheat. So wheat trades at equality. This is a chart from 1971. If we get more directional levels, we are looking far away higher prices in wheat in 5 waves. I'm still looking a couple of these channels. I don't want to put this, this is just a projection, a hypothesis. I'm still looking within channeling and some of the fib levels without the Elliott Wave stuff here. I hope we're going to stop some around here, because if we pass these levels, prices of wheat will definitely skyrocket higher technically. So soybeans is also potentially moving higher. Corn is also very bullish. So we are facing definitely a commodity breakdown on the upside from all sides. And it is just a question, will this continue for a longer period of time? So let me show you silver. Let me open the silver and gold discussion with the silver gold ratio. Okay, so this ratio actually measures which one will be stronger. Okay, so for the time being, from the 2020 COVID crisis, silver was performing better than gold. As you can see, we have a nice 5 waves down, and silver was moving up much stronger, while the gold was pretty much sideways. So now we have a little bit reverse situation. From this low, we have a 5 waves up. I do consider this now as a small pullback in a B wave and a move up in a gold silver ratio in a C wave towards 95.90, which means that gold will be favored for some time, which is very reasonable. And then we will go back into silver dominion for the next, I mean, when this unfolds on the upside for the next year, silver will also be dominant, potentially tracing 5 waves down. So to put that in a perspective with the gold chart and the silver chart, silver is behaving a little bit more heavier than gold. We had a move above this channel, but as you look this gold silver ratio, it's just telling you that gold might go up with a more kind of a consistent more stronger move further on the upside. We might be in a potentially starting this wave 3 on the upside with some targets. We traded exactly testing these previous highs around 2067. We are dropping now down, but this can just be a small pullback in already a beginning of a third wave. So in general, we have to look in this situation gold higher, sorry, with a possible small pullback and then a continuation on the upside. And look to this gold silver ratio. In one moment, this will change substantially. So I think it's a good chart to track, and don't be surprised if silver is going to be a little bit more heavier on the upside, looking this gold silver ratio than gold in the next couple of weeks. So if we go and look cryptos, Bitcoin is holding pretty nicely. We are trading at 42K. My triangle wave count is still holds. I still have a little bit more doubts in regards of are we going to have a little bit more push lower. 200 moving average is coming around 48. Also, this can be some type of an ending diagonal here in Y wave. So I'm not really picking sides here. I just have to be cognized of the fact that Bitcoin is still holding the sideways pattern. We didn't break a triangulation invalidation wave count, so I'm happy because of that. And overall, our wave count with the primary triangle scenario is still going on, and most likely it will finish in a couple of weeks or months or two, and then we're going to continue higher. In the case we break this 28,800. Obviously, I think that everybody who is in technical see that 20 to 22K will be next level. So for the more cryptos, you can join me tomorrow for a crypto lab. So back to you, Bennett.
Much appreciated. Thank you so much. As always, as Alex mentioned, if you are interested in more crypto-specific coverage, please don't hesitate to check out Crypto Lab tomorrow with Alex, 9 a.m. right here on the Trading Analysis YouTube channel. Before we wrap up, I'm going to give you guys a peek here at the Consumer Staples daily chart. As Terry had mentioned, we'd seen some progress off of the recent February 24th area low. This is another chart, obviously not favoring growth stocks and sectors, but ultimately showing a wave 4 here. The low of the 24th happened to be right at equality to our wave 2 of the same degree.
I'm going to zoom in on that a little bit,
Yeah,
because what I wanted to point out was, if you look, if you did like get your ruler out and measure the percent drawdown from that wave 3 high to say the February low there. So
yeah, so 7%.
That's 7. That one there is 7%. Okay, but if you and then we bounced, go back to the next high after that. The next high after that. Well, yeah, no, I was just saying from the
gotcha. From
wave 3. Yeah, So up until just a few days ago, the staples sector really had only been down about 2.5% from those all-time highs. Okay, that wave 3 is an all-time high for this particular sector. But then what I noticed then was this rapid drawdown that we had here in those last few bars. That's a huge move down. Okay, that move from right there. Well, the next move lower, but that's almost 100% retracement of that prior move. We're already past the 786. And usually if we get past the 786 with a close, which we did, we might actually be looking at the 1272. So Bennett's forecasting that 4v2 down there at 72. There's probably a 4v3 in there somewhere also lower. Before we finally anchor this, and then possibly we'll get, and I don't think we're going to have as an aggressive as a fifth wave as you're forecasting at the moment, but
I agree.
More likely there'll be a continuation to the upside. But staples is not growth, but it could be a store of value per se. Like I said, for while we've had 13% drawdown in the S&P and a maximum 20% so far in the NDX. And we're above those levels right now, barely. That the staples sector has just been more resilient, and this is. But I saw this huge push lower, which really got me concerned that maybe something larger might actually be unfolding in here. So your 38%'s down there at 68.
Yep.
I'm just wondering if you got an ABC X happening. And then we've already started A of another ABC down that might take us lower in the staples. So
I completely agree.
It's been resilient. Yeah, let me let you talk. I'll go ahead.
No, you're good. No, you're good. I was just commenting on your the point you made there about the fact that after that low of the 24th and we rallied back up, now that we've seen that almost 100% retracement, in addition to how significantly we faded the early March high, we also, if you'll notice here, and I'll zoom in a little bit, it was only 3 waves back. So to Terry's point, with 3 down, 3 back, and now a push south of the 786, it's likely we're going lower. And I bet you, Terry, if we drop in a quality of Y and W, we're getting lower into that 38% range. Yeah,
you guys just keep this on your radar. So we get a bigger reversal, and you see see the other sectors start to swing again, then the staples might actually have a little bit more pain involved.
Yep, very good, very good.
All right, we've gone long enough, Bennett. I think we got to head out of here.
Yep, I appreciate it. We appreciate all of you guys for taking time out of your Wednesday mornings to join us. Members, we'll see you in about 20 minutes for the member webinar. Check us out, anytimetradinganalysis.com. And as always, Thursday mornings, 9 a.m., Crypto Lab with Alex. Always a good time. We'll see you guys back, same time, same place next week. Alex, Terry, appreciate it, boys, as always.
All right. See you guys.
See you guys.
Take care. See you next week. Hey, greetings traders and investors, and welcome back as always. Ben at Tyndall, tradinganalysis.com. It's Monday, March 7th, 2022, and I wanted to take just a moment of your day to invite you to an upcoming webinar event we have taking place this coming Saturday, March 12th. This will be held at 9 a.m. Pacific, noon Eastern, and in this webinar, we're going to tackle the market volatility that we've seen so far this year. Now, there's been a lot of uncertainties from inflation to the Fed to, of course, the geopolitical uncertainties with the Russia and Ukraine situation. And many of you are left wondering if this is the start of a larger bear market trend. That's exactly the question we're going to look to answer this Saturday, March 12th, 9 a.m. Pacific, noon Eastern. Hope to see you there. Tradinganalysis.com/webinar to get signed up today. Take care.